Hello, everybody, and welcome back. Today, my guest is Peter Monson. He's a senior portfolio manager from Nikko Asset Management. Welcome, Peter.
Thank you, Thomas, and thank you for having me.
Peter, today we want to discuss recent developments in Asia and for Asian equities. So, for China, it seems as the worst is over regarding COVID-19 pandemic. For other Asian countries, the situation is more diverse. So what's your perception as a portfolio manager and specialist for Asian equities currently?
Sure. Well, I think China, Korea, and Taiwan have all handled the crisis with the least disruption to domestic economies and the health of their populations. And this has been on account of better containment measures, healthcare infrastructure is better, response times, contact tracing, mask wearing, etc. And practice really makes perfect in this part of the world. But also, there's been presence of stronger sovereign balance sheets, higher interest rates to begin with. But the monetary and fiscal stimulus has been very targeted there. China prioritized getting its industrial sector back on track, while Korea prioritized capital allocation towards some strategic industries in health, EV, green energy, and digital, etc. I think another more overlooked point is that all these economies are naturally more digitally orientated relative to global and EM peers. Another part that's probably not emphasized enough is that North Asia's exports have been in extremely high demand as a result of this crisis. A lot of production of healthcare equipment, technology, and renewables equipment takes place in North Asia. And I think all these sort of points remain valid and should see North Asia generate pretty decent sustainable returns near term at least. I think, as you mentioned, though, for the rest of Asia, it's pretty mixed, and I might split this into ASEAN and India. In ASEAN, containment success has been much more varied. Vietnam, Thailand, Singapore are faring a bit better, while Philippines and Indonesia have not been able to contain it so well. But Malaysia was containing it quite well, but has had recent resurgences in particular areas, so they've locked down in specific areas again. But in general, ASEAN is a bit more impacted too because they're more reliant on old economy type companies, banks, utilities, energy, which are all sort of still struggling. And what's more traditional services, and in particular tourism, is a big part of a lot of economies down here. And that doesn't look to be resuming in any meaningful way, at least until vaccines and treatments are available, which could be well into next year. And I think just lastly on ASEAN, there is some political discord in a couple of countries, and that's maybe preventing the passage of positive structural reforms. This is especially important as countries vie against each other to compete for reshoring opportunities as a result of trade tensions, etc., with China. So in summary, for ASEAN, we're sort of very selective there still. But I think in India, it too has struggled with containment. A nationwide lockdown in one of the most populous countries in the world and one of the more emerging ones caused a lot of disruption, which is still ongoing. But still, we find that India probably presents one of the best secular growth opportunities in our markets. It's a large domestic economy, the potential of which is being unlocked with positive structural reforms. In recent weeks, we've seen the agri and labour reforms come through, and that's evidence to us that Modi's agenda, albeit not perfect, is still on the right course, and together with the Make in India campaign should result in sort of better sustainable returns in the future. And I think, for India as a whole, we think the market correction is a good opportunity to add to a number of very good quality companies.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. To what extent is COVID-19 driving structural change in Asia? And in general, is Asia better prepared for those changes than the rest of the world?
Yeah, so it's a good question. I think 2020 has probably been one of the most significant years for structural change in recent memory. But in many ways, the pandemic has merely accelerated pre-existing changes that were already underway. Those would include things like digitization, trade conflict, which encompasses all kinds of words, deglobalization and reshoring and localization. There's a lot more consolidation within subsectors. We've seen a lot of evidence of Asia buying Asia where possible, particularly at the expense of the US. And again, consumption behavioral shifts. There's a lot of new ones in here, but a lot of pre-existing ones, again, related to more digitization, etc. But, part of the response has been to ramp up strategic industry development. So areas 5G technology, healthcare and green energy have seen a lot of focus. But, on the question of whether Asia is better prepared or not, I think I would rephrase it. I would say that in many ways, Asia is probably now leading some of these structural changes. And that's in part due to, again, North Asia and Asia emerging first and with least disruption. I think very targeted spending towards strategic industry development rather than, handouts that have been adopted in more Western countries. I think trust in governments is a really interesting one, and across most countries that has generally picked up a lot in Asia because they generally handle it quite well. So I think positive reforms have continued in a few countries despite the pandemic, which is very positive to us long term and is perhaps overlooked a bit because of everything else that's going on. So for us, we always prioritize looking for future sustainable returns in our stock investments, but we're very well aware that change is that much more prevalent in Asia, given the diversity of economies, the pace of development, the reform, and just the desire of individuals to improve their livelihoods.
The big elephant in the room is the trade conflict between China and the US and the uncertainty it brings with it. I was wondering, can ASEAN countries benefit from this trade conflict, or will their economies also be harmed by the trade conflict?
Yeah. Okay. So firstly, I think there's a lot of variables in that equation, and currently our thoughts that are that on its own, it's probably not enough to move whole economies, but there's certainly a number of stock-specific opportunities out there. And I'll explain that a little bit further. But if we look at this in terms of current exports, some countries are quite clearly more dependent on one superpower over the other. India and Vietnam towards the US, for example, or Korea, Hong Kong towards China. But ASEAN is very evenly split, though it's difficult. And, when two elephants collide, you don't want to be the grass. I think should relations continue to sour, we wouldn't discount, the increasing probability that some of these countries have to make decisions on which side they're on. And that'll cause quite a bit of disruption. But I think we'd also make the point that in order to attract FDI and reshoring opportunities at the moment, ASEAN is competing with India, and there will be competition. So those that can put through tax incentives, put through reforms and the ease of doing business are countries that will probably win more business from a top-down level. But as I said, it's more about stock-specific opportunities, we think. And if you look at the stock level, I think what multinational companies are now having to do is, it used to be all about the most efficiency you can squeeze out of your supply chain, whereas now it's a lot more about the resilience and maybe the versatility you can have and being close to the end demand where possible. So this will create some opportunities in both ASEAN and India and other EM countries for that matter. But I think we caution overestimating how much can move out of China. The sheer advantages in terms of their manufacturing capabilities, the infrastructure, the logistics, the quality of the production, the capacity, is not easy to replicate. So China's always been very happy to see lower end manufacturing and as it moves up the value chain, but we don't see sort of wholesale opportunities as a result of that unless relations really did sour materially. So I think in summary, there's still a lot of unknowns, a lot of variables to the equation, but there are a lot of good quality companies in parts of ASEAN who are well positioned. And if and when it does come, the delta or the earnings pickup can be really, really significant.
Recently, we have seen a lot of foreign investors' money outflow, especially out of emerging Asia. So what's the reason and what is the event that will trigger the return of all that money?
Another good question. So, I mean, I think given the extreme levels of uncertainty at the onset of the pandemic, and it did start in Asia, we saw a lot of foreign investors just pulling money and asking questions later, really without assessing the true extent of the damage. And I think, as we've discussed in many ways, Asia is emerging first and arguably strongest. So I think it's more about a greater realization of this, perhaps, that the relative growth differentials are better. There's still yield available in Asia. But we probably also need to see some headwinds to US tech and FANG stocks, etc., for people to really look at rotating on in a big way.
So currently we see a lot of central bank money flowing into the market, and we have seen that steep recovery of global equity since the second quarter. So what is your view on current stock prices, valuations in Asia, and especially about Chinese technology stocks?
So we've certainly observed, I would say, some evidence of irrational exuberance in valuations just in pockets in Asia, particularly over the summer period. And again, as you say, a combination of retail flows, loose monetary policy, and just general optimism around the structural change in all things digital led to a lot of that. But the broader market remains relatively cheap in our view, I think especially given the relative attractiveness of growth levels and yield. But with respect specifically to China tech and A share, this was certainly one area where valuations had run ahead of fundamentals. And again, this is in part, we think, due to China's response to US tensions and entity lists, has really been to ratchet up investment in areas where they're still reliant on foreign technology, together with other strategic industry development. And that includes things like 5G and now green energy. So, there were several high-profile listings on Starboard, for example, which is the new board they've opened, which is sort of a Nasdaq-like equivalent to raise capital from the local markets. And this certainly contributed to the exuberance. When you have new listings popping 200+% on day one, you get a lot of interested buyers in future listings, and that's certainly what we saw. But I would also note that over the last 1 to 2 months, those valuations have somewhat corrected. And while I don't think you would call them cheap, they're certainly not excessively expensive anymore, or as they were.
So where do you find currently investment opportunities for your portfolio? Which industries and stocks do you like?
Sure. Well, first and foremost, just to reiterate that we are bottom-up fundamental stock pickers, and we like to identify long-term investment opportunities. The two key pillars that we look for in companies are the ability to generate sustainable returns over the long term and positive change. And we call this harvesting growth, harnessing change. Again, Asia is pretty well known for the structural growth opportunities, but as discussed, this year has probably highlighted more than any other the importance of understanding, anticipating and reacting to that change when you're assessing those opportunities. But we find this to be a pretty rich environment for stock picking. And the current areas that we have good representation in portfolios is in areas of healthcare, in areas of environment, which has now become another big priority, really as a policy reaction to COVID-19, interestingly. Some subsectors of consumer too, where we've observed pretty significant changes to consumption behavior. Manufacturing upgrade, and again, this encompasses a lot of things like automation, industrial IoT, software and logistics, but that's another area that still looks pretty attractive to us. And lastly, just from a sector point of view, within finance is sort of the more digital end, but also life insurance, which again, a face-to-face business was impacted by COVID-19, but as we see North Asian economies start to open up, that should start to come back again. If we look at that from more of a country perspective, in North Asia, we're now finding more attractively valued opportunities in some of the old economy type businesses, dare I say, which are benefiting from, again, that reopening that we're seeing, but also those changes in consumption behavior. So personal mobility and life insurance is one that we've talked about. But also at the country level, is India, where we're encouraged to see the positive reforms still coming through, and that's still on. and we think at a large extent it's been overlooked by the market concerns on pandemic, and we think that presents a great opportunity. But I kind of just overall wanted to sort of re-highlight it's from the interactions and the companies that we invest in and that we speak to that are potential candidates. We're just very excited about a number of attractive opportunities that we're finding now, and that there's definitely pockets of the market that's been overly exuberant, but it's left a lot of other attractive opportunities that should start to see improving fundamentals going forwards.
So this was Peter Monson from Nikko Asset Management. Thank you very much, Peter, for being with us today and sharing your views.
Yeah, great to be here. Thanks very much.